Okay, it's 12:01. I was always taught to wait 2 minutes before you start your presentation, just for somebody who's halfway through the door. So we're gonna kind of get going, but keep an eye on the door. But thank you for coming. For those that are not here, we have 300 residents at Smith Ranch Homes, and I'm not counting 300 residents. But I know there's some empty spots. We are also recording this event so that if you just couldn't make it today, we're gonna have this on our website along with all of our other information that we're going over today, as well as additional information. There's no shortage of insurance information for you from the association. But whatever we present today does not replace you consulting your own licensed insurance broker as well too. So we hope that you can take the information that you learned today, surround yourself with your family and your professionals, and go through the materials and see what works for you, because everybody's going to be a little bit different. But you're the lucky ones, because all of those that are not here today are not going to see this great presentation that Lynn Wallace and Cliff Shulroy and I have put together. We may have a special guest or two along the way. But first and foremost, can everybody hear me in the back of the room okay? Thumbs up if you can hear me. Excellent, okay. Well, Cliff, we're already on to a good spot, so that's good. So today, we're gonna try to keep this simple. Who would like to be my official timekeeper? Anybody have a phone or a watch that they can rely on, that they know will not run out of battery? Okay, Ms. Berkowitz, I'm gonna ask you to keep an eye on the clock for 12:45. We're hoping to do this in an hour. I don't think anybody wants to talk about insurance for more than an hour. Sorry, Lynn. That's really just a fact. But Mrs. Berkowitz, if you can give us just a hand wave at 12:45, we know at that point it's time to wrap it up. But if you look at our syllabus, if you will, our items, it's actually a pretty simple day. We're gonna do some introductions, also a general insurance overview. It's not just about Motus. We've heard about Motus. We've heard about earthquake insurance. We actually want to give you an A to Z, 30,000 foot, maybe dropping down to 10,000 feet, overview of our insurance program at Smith Ranch, how it affects you as the residents, open up the floor for Q&A, and these events are only as engaging as having people ask questions so we can give answers. So really, shake the tree of the opportunity you have right now to ask us the questions. No question is small or too big, and really it helps us, because if it's just crickets in the audience, we don't know if we're really presenting the information in a good way or not. So please generate some ideas as we're presenting this, and then we're going to replay the Motus Zoom session that we had last week, I think it was, last Wednesday. So if you missed that session, we're going to replay it here, but we also have this presentation on our website. When I reference the website, if you go onto our private side of our website, under About, there's a board document section. If you go to the board area, there's a little sub-insurance area. Didn't say it was going to be easy, but it's on the website. Under there is a link to this presentation. There's a link to this video. There's a link to all the documents that you really want to have representing the association. I got the easy part to do this warm-up act. I think I'm going to lean on our professionals as we go through here. But there's a lot of people that helped us get to this exact spot, and it's really worth noting publicly on these names, but also who are you going to be hearing from today too. First and foremost, Jerry Lewis and Bruce Morse and the entire finance committee last year asked ourselves, hey, are we paying for earthquake insurance that makes sense or doesn't make sense? We know that there's a 1998 seismic evaluation of Smith Ranch Homes. Maybe it's time to update it. And you're going to hear about that process a little bit later, but just really wanted to acknowledge Jerry and Bruce and the entire finance committee on this process. Gary's in the back. Gary Scholes, our board treasurer, worked heavily with the finance committee and with Cliff, our Smith Ranch Homes Finance Committee chairperson and assistant treasurer. It's a good business card. And you know me, so we can gloss right through. Daria Carrillo, boy, when she came to start working at Smith Ranch Homes 3 months ago, she had no idea what she was walking into, which was this entire reorganization of earthquake insurance, along with 1,000 other things. We have Lynn Wallace here today. Lynn, can you stand up just for a quick second?
No.
Lynn is our commercial insurance strategist and partner at Acrisure, essentially our insurance broker. And Lynn has been working with us for over 15 years-ish, right? knows us very well, has been through us in the highs and the lows regarding all insurance. Alex Yanev is the EQE consultant who redid the earthquake or seismic evaluation that this company did in '98. So his company came back and did a refresh. And then Alex Jeffers, our second Alex, is the CFO of Motus Insurance. He's going to be the one that you see on the Motus presentation. A lot of names and faces. Some you know, some you don't. But there's some names that we want you to get going and knowing a little bit more. But first, presentation 101 is to warm up the crowd a little bit. That's what Glenn Phillips told me in sales. So, Cliff, you had an interesting contribution here. Mark Rober is a NASA engineer who has 12 billion views on YouTube. Jeez. 69 million subscribers. I think Smith Ranch Homes has about 38 subscribers right now. But he does a lot of cool applications of his science principles, and specifically tying into squirrels. Too bad it wasn't turkeys or skunks or deer like we have here. But we're gonna do a little quick video, and it has absolutely nothing to do with insurance. Just know that. But we're gonna watch 3 minutes of just a palate cleanser as we head into the big times of insurance. So bear with me here. Technical potential difficulties. Okay, so Cliff, you have a microphone. This guy essentially has a contraption set up in his backyard on how he's trying to manage the squirrels, and he puts them through the ringer, not literally, but I guess figuratively. So
fully extend their arms and legs to act as shock-absorbing landing gear. This is so cool. Now back to the course where even Smart Rick eventually lets his guard down, which is exactly when she strikes. But just like all the other obstacles so far, after a day or two, they'd mastered it. In this case, even disregarding her offering of a fresh walnut. Now onto the Slinky Bridge of Deception, and this was the sleeper obstacle in my book. That is not a large gap, which they can easily jump, but having the Slinky there just threw them off somehow. You can see how much Frank is struggling here, and he's the brave one. And Rick only jumps when Marty shows up for emotional support. But like all the obstacles so far, after a day or two, they'd mastered it. Now onto our third to last obstacle, the tourist trap. And this one was just a freaking delight. A little peanut butter really did the trick here. Now here comes Fat Gus, and I mean, how Fat Gus is this? He sees the camera and he's like, paint me like one of your French squirrels. Yeah. No? No takers? Alright. Here's another classic Gus where he looks at the camera. Wait a second. Play that back. And freeze. Zoom, enhance.
Alright, that hit the ad. So we're gonna break off from that clip if you don't mind, just because we don't want to spend all our time watching YouTube videos. That's what my kids do.
But if you want a real good laugh, go home and watch it from start to finish. The thing is just hilarious. This all starts because he's got a bird feeder in his backyard. And he's got squirrels. He lives down in the peninsula there. And the squirrels are always getting into the bird seed. And he says, okay, I'm going to outsmart them. And he goes through this whole effort to outsmart these squirrels. And in the end, you'll be surprised. So, but watch it, it's really funny. Then he's done another one. He's done a 2.0 squirrel obstacle course as well. But it's quite delightful.
Mark Rober. All right, so you're learning a lot today. Also, how we got here is now shifting away from squirrels and going back to earthquake insurance, but just insurance in general. I already shared how back a year ago was really, this is the first time Smith Ranch Homes kind of said, let's kick off a new evaluation of our insurance program. Premiums have been jumping exponentially over the last few years. Our earthquake insurance was sitting at about $100,000 premium for a number of years. There were rate passes year after year, and we thought, boy, we're lucky, until that same carrier completely reorganized themselves, and our premium went up about 1,000% to $550,000. And that was a rude awakening. So we shifted and moved away from that carrier, but we moved to a couple of other carriers to share that, but we were still paying about $300-something thousand. It jumped up significantly. Property insurance, you know the drill. All insurance lines are going up. Property taxes are going up. Everything's going up in cost. And we said to ourselves, we're close to paying $1 million a year on insurance premiums. What is the value of the coverage that we're actually paying for should something actually happen? And I really appreciate Cliff and Gary and the finance committee, because this is the group you have working on your behalf at Smith Ranch Homes. They're strategic thinkers. They're not thinking, well, let's just pay the bill and budget more and move on. They said there must be a smarter way. So we brought in Lynn Wallace, we sourced Alex Yenef, and then we engaged with EQE in 2024. And it took a little while, but then in July of this year, EQE completed their evaluation. The evaluation came out pretty good. We first asked Alex, when's the big earthquake coming? And he said, well, that's not one thing I'm going to tell you. But what I can tell you is that when a big one hits Smith Ranch Homes, based on our experience and based off of your construction, we feel like Smith Ranch is in a pretty good place. I'm not going to project the future, but I'm also going to tell you that your villas and your condo buildings are built in a way and have been reinforced over the years through some reconstruction that you really should not expect a complete loss throughout the entire campus. And I'll ask Cliff and Lynn to add a little color commentary, but it was generally saying it's not going to be great, but it's not going to be a disaster at Smith Ranch Homes. But we have identified that the clubhouse is built really well, but there's some soft spots that we feel like Smith Ranch Homes should look at over the next couple of years and still maintain some insurance. But acronyms can kind of start driving the crowd crazy, but AEL is an important acronym, the average expected loss. Alex's team said if a big one, a major event happens at Smith Ranch Homes, you should expect a $26 million loss. Our earthquake insurance coverage was at a $45 million loss. So right there we said, okay, what's reasonable in insurance? But we're also playing with homeowners' fundings and personal effects and expectations, so we don't want to be too aggressive, but some recommendations were made by the board in August. First, they said, forget insurance. There's a couple of things we want to do immediately. We want to get some gas seismic shutoff valves. So if there is an earthquake, we shut off the gas immediately. That was not per code when Smith Ranch was first built. Cliff has got a whooping stick here in case I get out of line. And Cliff is pointing those. Thank you, Cliff. Okay, I didn't know where you're going with that. We also want to make sure that in the next 3 years, we want to allocate some funding so that we can do a clubhouse assessment on what do we want to do short-term, long-term to strengthen the clubhouse so that potentially the $26 million could even go down more if we do some smart steps. We also have the maintenance committee taking some of the findings of the study and said we want to do a proactive preventative maintenance program, and we have funding segregated in the 26 budget and beyond for us to be able to identify how do we be more proactive and preventative than reactionary, which we can be guilty of sometimes. We also created a new goal of a new disaster plan. We had a community disaster plan that had been in place for many years, but then was defunct a few years ago for various reasons. But our new target is that we want to have a new disaster plan, including earthquakes. Not that we don't have anything now, but we want to have a very sharp program by that particular date. So these are alternatives to insurance. Sometimes you can't do it all though, and you need insurance to fill the gap. We also want to create, and the board approved, a catastrophic sinking fund. In broad senses, we're spending $10 on an insurance policy that just is over-covering us. Let's spend $5 for a new policy. But let's not lose that $5 that we're not paying anymore. Let's put it into a fund and then keep adding to that fund over time and invest it wisely so that fund grows more and more. So if something was to happen, maybe we have an extra ancillary pot of money that can cover us as an association that can help offset some of the costs instead of always relying on insurance coverages. All these items will be detailed a little bit more as we go through our program. But the big one about our insurance is there's the $45 million limit that we had talked about earlier. There is also a 10% deductible. 10% deductible can be a very big number on a very large loss. So the committee made a recommendation, working with Lynn and others, that let's reduce the coverage to 20 million and reduce our deductible to 5%. And then in broad words, numbers, it probably reduced our premium from $300,000 to $125,000 or $150,000, maybe 180 now that I'm talking out loud. All right.
Yeah.
So we're talking about big numbers. And that difference of $100 and something thousand is now being shifted to that catastrophic event sinking fund. And next year's budget is going to have money to that tune, $100,000, $200,000 to keep contributing to that fund as well. We also recommended and the board approved, let's revise and present resident insurance coverages that we have for you today. As you walked in, there was a stack of papers, and I hope everybody grabbed a sheet of paper as they walked in. And if they didn't, if you could raise your hand, that's good. I'm going to ask Izzy if she can keep an eye on the phone or the hands. Izzy, if you could maybe look at the hands and get people a copy of this. We're going to get into it as well. But that's part of our recommendation. Let's not make changes and then just leave the residents alone. Let's make changes, but then make sure our disclosures are telling you what you should do or what you should consider, and also present it to you in a regular interval. We also subscribe to Motus. After all this is where Motus finally kicks in. What is Motus? It's a supplement for you. If we're going to decrease some of our association coverages and you feel like, well, I personally want a little more coverage for me, the association subscribed to be quote unquote pre-approved, if you will, for a lack of a better phrase. And then you have the opportunity to secure your own earthquake coverage through Motus. I'm going to turn this now over. I need a breather. Cliff, I'm going to ask you if you could maybe work in tandem with me, but also Lynn, don't be shy when we hit a spot where you feel like your color commentary would be of value. Cliff, we're not going to go through all 89 pages of this earthquake assessment, are we?
I think it's 37.
Okay.
The answer is no, but if you are interested, it is in our website, as Scott mentioned, under board and under insurance. This is going to be added there. It's a very good report, very well written. It's got lots of information, and we'll come back to that. So that's why that slide's up there, is to let you know that. So I would encourage people, if you're interested, go take a look at it. This is the chart that he put together. We will come back to that. This is dealing with our earthquake coverage. But I think before we get to that, what I think we'd like to do is maybe go to that next slide, this one. And but before, as part of this slide, which is the resident insurance coverage, and we've revised this. We've had it in the information packet for years, but it's been revised based on some new information. But Lynn's going to talk about the coverages that the association has, just to let you know, because there's an attachment to this that I'm going to have Lynn go over.
Great, that's a good foray for Lynn. Why don't you come on up here, Lynn? And as Lynn joins us, the front is this revised insurance coverage that we're not going to read every line of today. You don't want that, but it does tell you where we start and stop, and then where you should consider. And then on the back side, do we need to maybe get you?
The box thing that shows the different coverages.
How about that?
That would be it.
There you go.
Oh, it's
All right, make sure your mic's on, Lynn.
Okay, here we go. So to make it simple, I'm going to go in a broad way down. So if you end up having a question, just raise your hand and do it right at that moment. But the association carries insurance on behalf of the association, and there is benefit to everyone as a part of that. It's distinctly separate from the insurance that the residents buy. So we'll start first with the property insurance. So anybody have an idea of what property insurance would cover, the kinds of things that it covers as a risk? Anybody have a thought of what property insurance would cover?
Fire.
Fire. Who said? Oh, you have the cliff notes here. Yeah, it covers fire. It covers water damage. It covers if a vehicle were to run into the building by, chance. A number of different things that damage the property that is owned by the association, okay? So that's the first thing. This particular policy, property does not cover earthquake because we have separate coverage for that. But you're thinking about wildfire, all of those sorts of things, they're covered under the property if we need to make a claim on that. General liability, that is regarding negligence. Someone slips and falls and says it's some fault of the association. General liability picks up the association's negligence in that regard. Bodily injury, property damage, personal injury, that's like libel, slander, defamation of character. These are all things that someone could be negligent of, and that's what's covered under general liability. Automobiles and garage keepers. So automobiles cover the vehicles that are owned by the association, but it also covers the garage keepers is the valet. When somebody valets the car, there's protection there under the auto policy for that. Crime and employee bonding. So crime is employee dishonesty, could also be third party, where there's a theft of some kind of money or something like that.
4.5 million. That's a lot. 4.5 million. Limit.
There may be some separate bonds that are added up in that, but anyway.
Yeah.
Question.
Yes.
Here you go. You're talking about crime.
I think you might not be on.
Yeah, hold on. The battery's down on this. I'm sorry.
Here, use mine.
Now, this is just HOA crime, not any personal crime.
Right, it's HOA.
4.5 million.
I have a feeling that's probably not correct. I think they have something else added in there. I don't know.
Yeah, there was a evaluation on that one because it's actually the amount of our reserves times something. There's a formula that took us to get to that dollar amount. And in real time, if we find that to be oddly high or low, it was a number that a formula told us based on insurance requirements that we had to maintain.
I also put 2 million on liability for an HOA. 2 million doesn't sound like very much.
Well, we're getting there. There's excess liability. That's the primary policy.
Okay.
Yeah. No problem. Thank you for asking those questions. The other thing they need to know is that homeowners associations have legal requirements as to what they need to carry based on how large they are, how many residents, in terms of what limits they need to carry on different things. But the general liability, the primary policy is $2 million. Skip down to excess liability, umbrella. There's another $10 million on top of that. Okay, so if something were to happen that's catastrophic, yes.
I have a question on automobiles.
If your car is in the garage, an automobile, and we have an earthquake, that's outside of the walls of our condo. Would that be covered under Smith Ranch's policy or our policy?
Your policy. So your vehicle is damaged because of an earthquake. So it's not the responsibility of Smith Ranch to take care of the vehicle. So that's part of your vehicle.
If it's in the garage?
Huh?
If it's in the garage?
Yeah, if there's an earthquake
Yes.
that damages your vehicle, it's not a negligent part of anything that happened. It would be covered by
Lynn, we have a couple of sweet spots with our speakers. Do you mind just taking a step maybe that way? And you're going to be good. And just don't move. No, I'm kidding.
Okay. Liquor liability, there's a liquor exposure that has to do with the food and beverage that we serve. That also is a component that's covered under the excess liability as well. So you see $1 million here, but then you have another $10 million on top. Equipment breakdown, that's HVAC related. So if we, under the property policy, they would exclude HVAC, heating, air conditioning, electrical panels, things like that. So if we have some damage to those, it's covered under the equipment breakdown coverage. So that's physical damage to the air conditioning system, the electrical panels, heating system.
So if we had a terrible windstorm and a tree falls down and smacks in the roof and damages that equipment, it's covered under that
Correct.
insurance.
That's okay. You can have as many questions, there's no limit on questions.
That amount would cover the common area equipment, but also under the HOA, things like air conditioning is covered for our units
Yes.
also. So does that cover both
Yes.
our unit and
The
the
air
common
conditioning,
area?
yes, because that's part of the structure.
This is good. I'm glad we're asking questions. We have Izzy in the middle of the walkway, so if you do have a question, just give Izzy a beat to hand you a microphone so we can hear your questions too.
So I got to get out of jail card free because I had to move. Okay, directors and officers liability, that is, protects those people who agree to take the responsibility of becoming a director or officer. It can even be a committee member where they're making decisions on behalf of the board. This gives them protection if there's an error or a mistake or something that happens in terms of the decision making. Directors and officers liability protects the association. That's also required by law that it be carried. Earthquake. I'll tell you what, before we hit the earthquake, I'm going to jump down to the last one, that's workers' comp. Everybody know what workers' comp covers for employees that work here? So earthquake, that's where we made the adjustment, and that's policy used to have a $45 million limit and a 10% deductible, and now it has a 5% deductible and a $20 million limit. So any questions on any of that?
And we'll go through a couple of examples on the earthquake as we get down to that discussion.
Any surprises or anything you weren't expecting is covered, or what you're missing that you don't see that you're wondering if it's covered?
I'll add just one other comment. As part of our study, we looked at the deductible for the policies other than earthquake and had discussion with Scott and management, and it was decided that we would raise the deductible on all the policies where we could up to $100,000 and establish a component in reserves of $100,000 with an expected life of 7 years. So that would mean that we were guessing that we'd have a claim every 7 years. So that's what we've done to help reduce the cost of insurance.
And we interestingly filed a claim the next year, this year, when we had our water damage. But it is the strategy on how to keep those premiums decreased on an annual basis. But the amount of funding that we have at Smith Ranch Homes, $100,000, is commiserate with the amount of budget that we have, which was a good move. Cliff, where do you want to go in terms of the earthquake? We have the Motus breakdown that actually kind of starts talking about the deductible, or do you want to go back to Alex's study of loss?
Well, I would prefer to go back to that first page on the residence insurance coverage, this one, and point out just a couple of things.
Sure.
And the first one is this, that residents should understand that our insurance coverage and what the association is responsible for is a walls out policy. So that says, okay, from the sheetrock wall, from here on out to the siding, the windows, the doors on out, but nothing inside. The residents have to understand that they are responsible for any damage inside their unit, with a couple of exceptions. But let's just say any damage inside their unit. So we tried to emphasize that again, and we've done down here that residents are reminded that neither the association nor the association's insurance covers residents' personal property. You are encouraged to consult with your own insurance agent or broker to obtain appropriate coverages. And we'll go through that. And another thing I want to point out, this one, the condominium HO6 policy, which is a standard, what we would call homeowners insurance policy. Please consult with your agent regarding coverage. 70% of all claims involving an HOA are water damage claims. So some HO6 policies may exclude water damage. You can probably add an endorsement to that policy, but you need to check that you've got coverage for water damage, coverage for fire sprinkler damage. All of our buildings have fire sprinklers. They are a wet system. If something malfunctions, that sprinkler could go off and you get water. It could cause damage. So please consult with your insurance agent regarding appropriate coverage.
We also included another clause, and this could almost be a whole other presentation, but particularly because of our stacked condo units, there is language about sewer backups and plumbing as well. We know, unfortunately, that issues can arise through clogs that are brought on by other units. If you remember that other bullet point we had, which was a preventative maintenance program, we do preventatively maintain the condo system where we'll clean out the main drains and we'll scour jet the sewer system. But at the same time, if there is an unfortunate loss, we direct the homeowners to file a claim through your personal insurance policy. And then if there is cause to go after another unit because of the findings on what we were able to establish that it was wipes from a different unit or something, your insurance company can then subrogate or go after that. But this has been a consistent trend. We know that we're trying to promote to the community. Don't stuff things down your toilets or your sinks, but unfortunately we're seeing that trend. But we want to guide residents. What do you do? And if it's not in writing, no one's going to really remember. So we added that too.
Can I just mention, oh, go ahead.
Mrs. Berkowitz?
The question I have about water damage is, suppose I live on the 3rd floor and there's a leak in my toilet, but I don't know it, and it's going down to the 2nd floor. Who is responsible for that? The 3rd floor owner or the 2nd floor owner? Who is getting the damage?
I'm going to shift, not the blame, but I'll shift to Lynn. Can you answer that? And then I can add a
Well,
little-
you know, in all of those kind of claims, there's investigation, so it's hard for anyone to say, well, in that case, this is what's going to happen. But if you have a leak in your toilet and we find first of all, what's the reason for the leak? You know, how come it happened? And then from there, you kind of figure out, you start with your own, like the person that's right below, then they're going to their insurance carrier first to say, I have damage to my carpets, I have right, I'm going to go there. You would let the association know as well, so we can see what damage has happened to the building itself. It sort of gets sorts out from there, but always the unit owner's damage starts with their own policy, and then it kind of backs up as the investigation goes on to determine who's responsible. I will also say one thing to mention on the water damage, if you're asking your insurance agent about coverage, make sure that I have coverage for sprinkler leakage and so forth. Just remember, earthquake sprinkler leakage is not automatic. If they say, yes, you're covered for sprinkler leakage, you have to ask it, but that has to include earthquake because that's a separate coverage, always separate. So they could say to you, yes, you have coverage, and then we have an earthquake and you have water all over the place. They're saying, well, you didn't buy the earthquake coverage. So it's just key to know that anything related to earthquake, which is another reason why we just brought up the Motus program, because it is a way to get a ton of stuff covered for earthquake in actually maybe a better way than trying to buy a little piece here and there on policy. So that's the idea of it. But just know, that's always separate.
And let me just add one other thing that we've got here. Flood insurance for those that are on the ground floor and for the villas. We don't think we're in a flood zone. I pulled up an article regarding the 1862 mega flood here in California where the Central Valley was covered with up to 30 feet of water. And so when we've all seen the news going on the last few years and these terrible floods like down in Texas, floods in, Virginia or the Carolinas, we could easily face rains that go on for days and days and days. And any water seeping into one's residence from outside is considered flood. So you ought to, flood insurance is relatively cheap when you're not in a flood zone. So again, you ought to talk to your insurance broker about that. If you live on a ground floor unit, I don't think it's too important if you're on the second or third floor, but if you're on the ground floor, I think it's something you should consider.
I'm going to put on my Mrs. Berkowitz hat right now and just say that it is 12:35, so I want to keep us moving on our information here. Do we want to go back to Alex's number here just to kind of cover how we got the $26 million?
All right, moving on to earthquake. So again, let me remind people, we live in earthquake country. They have two faults, one on our east, which is the Hayward-Rogers Creek fault, one on our west, which is the San Andreas. Rogers Creek is 7 miles to the east, San Andreas is 11 miles to the west. So we encourage people to think about earthquake insurance. I know some people are going to say, well, I've been in this area for 50 years and I've never had earthquake. Okay, that could be understandable, but coverage extends, or damage could extend to all of our common area property, which includes the building, the swimming pool, parking structure, the driveways, etc. And you, resident, would be responsible for a proportionate share of that damage. So we'll get into that. So Alex went through and put together all of looking at the buildings and the property, but the insured value, that's this one, square footage, this is the estimated replacement cost, and we'll get to that shortly again. And then he came up with what he calls the average estimated loss. This is the damage that each one of these buildings could suffer in what he would say would be in I'm not going to say normal, but a significant earthquake event that we could face. And then he comes down to a total now of 26 million, as we said earlier. That was part of the decision by management, and the board to reduce our coverage from 45 million down to 20 million, because it was believed that even in a major event, we wouldn't suffer that $45 million worth of damage.
This is an estimate. But before, it was much more of a finger in the wind. Now we have some numbers to help guide the association on what is a reasonable estimate. And I think that's what we've really successfully achieved in the last 12 months. Question, Lynn? Izzy, if you can bring that microphone around.
I did not see the,
Oh, I'm sorry.
I have not seen the first presentation, so maybe it was in there. But you're saying $26 million estimate, and this paper here says 150.
So that.
We are going to get into that actually. So let me just validate that question.
I was just gonna say that this is for the whole project, everything, that relates to one unit. That's it, the Motus program, if you didn't see, that's the
No,
insurance for the individual.
I think,
Yeah, we'll go.
Yeah. Greer?
I'm a little confused about the line, the estimated, the damage. And by villa, by building, I thought that we were talking about insurance for this building and not for an individual villa. Could you explain that?
well, we're talking about coverage on all of the common area property of the association. So again, the common area is from the wall, from the sheetrock wall out.
I see. So when you say Villa 4, that's the damage for the sheetrock out.
Right, not the interior, but out. So if the exterior is damaged, the windows crack and has to be replaced. You got a door that comes off of its hinges. Roof gets damage to it. That would be common area. But the inside.
Yeah, I understand that. So the sheetrock out for a villa could be $4 million?
Well, because the villas include some villas are 1 unit, some are 2, and some are 3. And so we have 12 separate villa buildings, and that's why you'll see a difference in the cost.
I see. Thank you.
So that's the value. This is kind of the cost estimate of what it would take to repair. Because Alex's study came in and said, your condo buildings and villas are really built strong. Here are the numbers to consider, but we really focused on this number first, which was the clubhouse. And to reduce from 45 million down to 8 left people a little uncomfortable. So we said, well, maybe 10 million just to cover this. But we said, wow, that's still a big drastic amount. So let's get enough to kind of cover our community. It doesn't have to be just for the clubhouse. It's an amount that shifts us from 45. Then we looked at 15, and there was almost no price difference between 15 and 20. So we said, this first stage, we're going to go to 20 million. But there is a plan that if we maybe made this number much smaller because of improvements we can make over the next few years, that's going to reduce that, and we would then shift to maybe a smaller coverage.
So, in case of an earthquake, what people need to understand.
Hey, Cliff, really quick. Sorry, I don't want to.
Oh,
We do have a question, though. Izzy?
sorry.
Just curious, why the difference in building 400 compared to the other condos?
Building 400 has a garage. And so that garage adds.
Yeah, that's actually a 3.6 million. Not that far off, but the 8 is. The clubhouse is different because it was not renovated during our seismic retrofits in 2005. All the other condo buildings were, but maybe that extra $500,000 would be related to the garage.
I'm sorry?
I was looking at the 51, the estimated replacement.
Yeah, 51 million here compared to some of the others, and that's the big reason is because of the parking structure that's in there. So, in case of an earthquake, if we have an earthquake, and we'll come to a couple examples, but the first dollar of damage is under the 5% deductible on the master policy. Now, and let me back up. This applies to damage to common area property. That's what we're talking about right now. Just common area, not to any damage inside your residence, but common area. So the first dollar falls underneath that. And it's 5% of the replacement cost of the structure that was damaged. So Scott, you want to go back to the other slide real quick? So we're looking at this number, the replacement value. So in building 500, 5% is $3 million. So if we have suffered a $4 million worth of damage on building 500, there's a $3 million deductible. So it's a sizable number. And we'll come to an example. All right. Hopefully, so that's the first dollar. Then the next dollar of coverage, once we've exceeded this 5% deductible amount, comes into the 20 million master policy. And it's our belief, and it's Alex Yanos' professional opinion, that the vast majority of earthquakes that we could ever suffer, we're never going to get beyond that. But if we get beyond that, this amount beyond that comes back to the residents. The residents will have to cover that as they'll have to cover this right now out of a special assessment. So you need to understand that. If we have an earthquake, the first dollars, if you have it tomorrow, it's going to be covered by a special assessment. There are some ways to discuss it, but it's ultimately going to fall back on us. It's not going to be covered by insurance. It's going to fall back on us. And then once we exceed 20 million, it falls back on us. And that's where we think the Motus insurance program is of great value. So, here's a couple of examples real quick, because I think maybe that helps you to understand it. So, if we have an earthquake, and I've come up with a couple scenarios here, and the total incurred loss is $11 million. So we have, let me add one thing. Alex says in an earthquake, all buildings are not going to be damaged at all. You may have damage to one or two and none to others. And Lynn could attest to that. Lynn, maybe you want to mention your experience.
Well, I know when Loma Prieta happened, we had a number of earthquake policies all over the place, San Francisco, up here, but I do remember was a building in Tiburon. It was an apartment complex with 15 buildings. And very interestingly, building 1 through 14, no damage at all. for whatever reason, again, this is in Tiburon, it's on a hill, but building 15 slipped down the hill. And so, you know, a lot of conversation about, not just about how you rebuild it, but how do you support the ground and all of these kinds of things, but absolutely no damage anywhere else, one building. So, and I think that's what we all know about earthquakes. The building next door to a building that's damaged has no damage. So we really don't know where it's gonna hit, which is also another reason that we bought a $20 million limit that would be applicable to the whole property and not just the clubhouse. Because we talked about just insuring the clubhouse, and we thought, well, if we're gonna buy 20 million, we're gonna have a risk. Why don't we buy it on everything? Because what if we have an earthquake and nothing happens to the clubhouse, but something happens to one of the other buildings? We want to be able to move the money over there.
Excellent. So, again, in this example, there's $11 million of total, but the 5% deductible is $5 million. That's a deductible amount. And if the earthquake happens tomorrow, what will be paid for ultimately by a special assessment to a residence. We've established the sinking fund, as Scott has mentioned, and the goal is that as we go through time, that sinking fund assets will build up, and that will cover this. So there won't be a special assessment. That's what our goal is. So we're taking some of our insurance savings, putting it away, and hopefully over time we'll build it up, and this will not come back to the residents as a special assessment.
Cliff, have we taken into thought the fact that the replacement value will continue to rise based upon building costs and materials and labor?
Yes, in that we will be looking at this every couple of years because of that. The replacement cost that was on that slide, Alex had long discussions with Lynn and with Dave Sarman and his estimator to come up with reasonable ideas of what the replacement cost would be today on a square foot basis. And then we increase that by 30% for, as they call it, surge pricing in case of a disaster.
Could we build a CPI into the policy? Is that available?
No, usually what you do is you decide what limit you want to buy because you're not buying the full amount. You're
I understand,
buying,
but
yeah.
is there any clause that could be added as a CPI so we don't have to keep estimating and estimating?
Well, the thing is, the way the deductible works, and it's always worked this way, is it's on replacement cost at the time of loss. So there really isn't a CPI element of it because we're only going to be charged for whatever the replacement cost is. And I can tell you this, it's a really good question because that estimated replacement value, I really question Alex on it because it's, look at it, right now we have 154 million is the value that we're buying insurance on. Of course, we're only buying 20 million, so it doesn't really matter, right? Keeps the premiums down as you're being realistic, but 324 million, that's like $1,000 a square foot or so. It could be that. He gave us to that not because it's actually gonna cost us anything right now, but for us to be aware, what if it goes that high, that's what the deductible would be based on. So, you know, and at that point I was like, okay, I get it. It's really not gonna be that, it's gonna be whatever it really is, yeah.
Thank you.
So,
One little tiny one.
so again,
Let's work through this one, Lynn, if you don't mind, and then we'll circle back. Keep going, Cliff.
So, in addition to the deductible, there was some other area that could come into play so that your responsibility could be up to $6 million. So let's go to the next one. This is a major earthquake. Total loss, total damage to repair that damage is $36 million. The 5% deductible in this case, because more buildings were damaged, is now $8 million. Our resident responsibility could be up to $16 million. So just think about it. That's 4 times what the special assessment was a year ago for the villa damage, or 2 years ago for the villa damage. Because we had a special assessment of $4 million. This amount is $16 million, and that's 4 times what we did before.
this information kind of is hard then to go have a nice lunch afterwards. Like, what do you do with all this? The point is that this information is going to be also online. This entire PowerPoint presentation will be available. We want you to be able to download this, print it out. We can make more copies available at the resident services desk too. It's about just getting the concepts, because even me, I'm like, what the heck do I do if I was living here at Smith Ranch? But take this along with the other materials and then talk to your insurance agent. That's the person that'll guide you.
So maybe we go to that Motus, this one. So people have asked, what would I recommend? First question, do I think that I need earthquake insurance? So that's a personal decision, you gotta make that decision yourself, but I would ask you to think that you're gonna be covering your portion of a lot of common area in case of an earthquake. So think about that. And if you decide to do it, if you've got a normal unit and you don't have expensive flooring, you don't have expensive tile, you don't have tile on the walls or anything, then my recommendation is you go with this level of coverage right here, because that would, in essence, cover up to $55 million worth of damage. So that would be my recommendation. You go with the smallest amount. If you've got expensive things in there, or you've made extensive improvements into the interior, then you should consider going higher. Next, loss of use. People should look at that, because, as Alex said, in an earthquake, the chances are some buildings may be uninhabitable for a while because the water is not on. There's been a problem with the sewer, and so you can't use the building. This building, we may not have a kitchen operable if there's a major water break off the property. These things have to be, you have to think about those. So now, talking to Dean Porter, she said, well, I could go live with my son or daughter or something that's close by. And if you got that option, then maybe you don't need this. Next one is, this is a buy down for that special assessment, for that 5% deductible that we would cover. So it costs like $600, you can buy that down by 50%. That's another thing that people should consider. Just to let you know, for myself, I'm gonna go back to that.
Yeah, I just wanted to, that's where that affects then the deductible that we have. Actually, the line above, isn't the deductible at $5 million, right?
So you could buy your share of that down. And again, the goal is, as we build up that sinking fund, then the need for this goes away over time. That'll go away. Bye.
What does buy down mean? I think I know, but I want to hear it from you.
So currently the deductible is 5%, as we've mentioned, 5% of replacement cost. So if you pay $600 a year, then Motus would pay half of your share of that deductible. That's what it means. You're buying it down from 5% to 2.5%, or from 100% your responsibility to 50%.
And while we're not making official recommendations, I think some of the feedback when we were exploring Motus by professionals and others is, wow, there's a lot of value add here. But you can't do this and then not do that. It's kind of, you enter in by having a policy, and then there's the options that you can have thereafter. And I think we'll keep it simple like that, but that's why even that limited amount here gets you into that.
Yeah. I will tell you, from personally, I have earthquake insurance through the California Earthquake Authority. I'm paying $1,800 a year. I think for a little bit more money, I can get a much better product than the California Earthquake Authority. So that's why we're
Well, also, if you
people
look at,
this.
if you ever look at a comparison between the California Earthquake Authority coverage and the Motus coverage, I think if you're interested, in the handouts they give, they do a side by side. This is what California Earthquake Authority covers, this is what Motus covers, and the whole point was to provide something that's much richer.
There's a code on that enrollment material, and after our video, I'm going to show you on the website how you go to this website and enter in this code. We have, by enrolling in Motus as an association, we've already pre-approved our account, if you will. So it makes it pretty simple. There's still a couple of steps you have to go through, but SMT, so think Smith 903. I have not found anything interesting on 903 to remember that, but that's our code, SMT 903. But I think this would be the time then to remind everybody, smithranchhomes.org, on the board document under the financial area, there's the insurance subheader, go there. But Cliff, I think this might be the time to want to shift over to Alex Jeffers' presentation.
Well, any more questions?
In looking at the coverage, the 5 coverage offers, it seems to be a combination of our share of the our assessment, should we go over $20,000 in loss, and our own individual condo coverage. How do we know with this policy how much is allocated to one need and how much to the other?
It's combined. There is no specific allocation. So, if we never exceeded the 20 million level for the master coverage, then back on the other side, that part of the coverage would not apply. But if for the damage suffered in your unit, that's when it comes into play.
So I would get more to apply to my unit if I don't have to contribute.
Yes.
Yes.
But if there is an assessment for whatever we go over the 20 million, then I'll get less
Then
to
you
repair
have
my
less
unit.
dollars to use on your unit
So
improvements.
It's kind of like you have a pot of coverage. You know, you buy a limit, and then you allocate it yourself how you're going to pay. I'm going to apply to my assessment if I do, and then whatever's left I apply to wherever else I need it.
You do that ahead of time or once the disaster
Once the
happens?
disaster happens, yes. Because we don't know the facts until the disaster happens. We don't know if there's going to be an assessment. We don't know, how much damage you have. So you would always make that decision, how you're going to use your limit, once we know what the disaster is and what's happening.
Okay, another question that I've been getting from other residents is, will Motus be able to pay if we have a sizable disaster?
That's a really good question. So Motus is actually the managing general agent of the program, and it's insured with Palomar, which is a top A-rated insurance carrier. And so they have it all, set up with
Who backs up Palomar? Do they have a
Well,
reinsurance?
I'm sure they do. Yeah, I don't know which reinsurance carriers are on it, but we can give you a lot of
Single
information.
A-rated?
Pardon me?
Single A?
It's an A-rated carrier, and
Single
I think it's
Single A, yes.
Hold on, I think it's on here. Yeah, right up at the top there. A-rated, excellent.
But not triple A.
Yeah.
Well, no, in Best, AM Best, that rates insurance companies for their ability to keep their commitment to policyholders and their financial strength. It's a different rating than, say, S&P or something like that. It's an A, there's A plus, A plus plus, there's A minus, there's B plus, it's like that. Regarding the insurance company's ability to keep its commitment to policyholders. So an A-rated rating is an excellent rating, and then there's a Roman numeral financial rating of 1 to 15. And I'm not sure exactly what Palomar's is, but it's high up there. It's higher than 10, so I'm just not sure what the one is.
I know the finance committee spent that time looking at what is, I don't want to call it solvency, but what is backing up this plan. And I think there was high confidence that this is not a back alley operation that won't be able to pay.
And they are supported by reinsurance. So, again, if anybody wants to know more detail on that, we can get that. But just so you know, it's not just somebody who called himself Motus and says we're going to take care of everything.
Well, it is a relatively new company.
Well, Motus has been around, I think, about Motus itself, but it's a managing general agent. It's kind of like a broker that specializes in this.
Right.
Palomar is the carrier that's providing the coverage.
Palomar Holdings?
Well, it's Palomar, here, excess and surplus insurance company, it's probably part of Palomar Holdings, would be one of their carriers. Yeah.
Yeah, they're not new, but I would say this program is emerging just because HOAs are suffering this challenge of rising premium costs. So the industry itself is really trying to introduce this to communities because they need an offset because the increases of your unit assessments are going up exponentially. So what is a nice balancing act where we can shift some of the responsibility because you choose to elect to absorb that responsibility through you and not the general assessment. And I think with the phrasing I just told you about multi-year increases of 20, 30, 40%, we're trying to find an alternative solution. Lynn, you did have a question that I wanted to circle back on. Maybe we answered it, but
One of the previous shots there showed $11 million loss. So 5% of 11 million is not 5 million.
It's a 5% of the replacement cost of the building at the time of the loss, not 5% of the loss.
so it goes back to again.
No, but you're talking about the deductible, aren't you?
Right. Yeah.
So the deductible on a $11 million loss is what?
Well, you would go back to whatever the replacement cost of the building is.
And that was an add-on. It's kind of not
I know,
surprised.
people it's very common, people think that the deductible applies to the loss. But in earthquake insurance, it always applies to the replacement cost of the building at the time of the loss. So let's just say,
It said the loss was 11 million.
right, and
Okay.
that's correct. And the deductible applies to the replacement cost of the total building. That 11 million loss is not assuming a whole building is gone. It's assuming there was damage to a building. I know, it's up, but just so you know, always remember, they're gonna look at what is the total replacement cost of the building, and then they put the deductible.
That was an aha moment for the finance committee because we recognize that we're writing a policy for some values that we state, but that's not what the deductible is based off of. It's not even based on the amount of loss that you incurred. It's what does it cost to replace your building at the time of the loss. So that number just jumped significantly because of the surge cost that showed even more of a challenge of that deductible just being a number that is really just impossible to really address. So look at this pink column. That's what's driving your deductible, not the actual loss that we incurred. Now I know I was not here last Wednesday. The Motus presentation is an hour long. I didn't realize that,
Yes.
Alice. So we're not going to replay that today, but that's available, again, just with everything else on our insurance landing page. And I would encourage you, while it's fresh in your head, to watch it. It's with other residents asking questions as well that might be addressed that you might have in your head still, but you can also watch this at any time along with our materials. Mrs. Berkowitz?
This is very confusing.
Yeah?
So what I'm taking from this is that the Motus sheet with the different prices that we can pick from is, if you're saying that most likely not every single building is going to be demolished or even partially hit. Let's say the clubhouse is hit, but all the residential buildings, including the villas, are fine. This thing that we're paying, let's say we do what Cliff said, go for the $100,000 price, and we're paying X amount of dollars a year. But that is only for our own unit. Is that correct? No.
Excess policy too. Lynn, do you want to briefly?
That's the confusing part.
That's all right. I'm confused too.
It will cover whatever losses of the building, whatever, that kind of a piece, as well as the interior of your unit.
Yeah.
So for example, let's just say, if there's no insurance, so let me back up. Remember the $36 million loss, and then it was coming down to 16 million? Well, if you look at the in-between that, what's the difference between 36 and 16? 20 million. So that 20 million is being picked up by actual insurance. So the rest is a 5% deductible, and then it's whatever is not insured left over. So it covers in your building whatever is being insured, and then if you buy the part of the deductible buy down, that applies to any kind of assessment that's put back on you. And then I do know, let me just tell you, I know it comes off confusing because they're trying to make sure that they can offer something as broad as possible. That could be interior unit, damage to the building, and if you want it, loss of use to pay for you to go stay somewhere else, and if you wanted, half of the deductible bought down, which is what actually for me, I like that piece the best, actually. Just the idea that if something happened, that I would be able to not have to be facing the full deductible, my share, I get part of it.
And while insurance professionals may be very linear type people, the concepts of insurance is just not linear. It's not black and white. When's the big earthquake? We don't know. Where's it gonna hit? We have no idea. So why are there licensed insurance agents? That's why we really encourage you to take this information and don't just sit in your armchair and say, I'll go with this. We really encourage you to get the other pros in your life, to understand your circumstances way better than we do about your risk tolerance and such, and then walk through this process.
Do we have any more forms, enrollment forms available?
We do. I don't know where they are currently today. I would recognize we should have some here. We can run some off really quickly. We'll also have some at the resident services desk as soon as possible, and probably in the mail room too. But it's also on our website on the insurance spot that I've referenced.
And you could go online, as it says here, and they've got on their online, because I did it, there's a little slide bar that you can select the amount of coverage from $100,000 up to $800,000. And you just slide that slide bar and it adjusts the premium. It's real simple to do when you look at it.
I would also say, if you have some interest, then do watch the video where Alex, who runs this whole thing, the CFO there, explains that program. He just goes very methodically through it. So if it's something that you have some interest in, it's worth it, even if you only invested in the first half of it and watch, because he goes through and explains it. At some point, even for me, as I was looking at, because it's a new way of doing things for earthquake for unit owners, all of a sudden the light bulb goes on, and you go, I get it, I see what's happening. So I would just recommend, if you're interested in it, you'd like to invest in, watching that video.
And I'll ask maybe this Saturday, we always have movies. We could do a movie, but maybe instead of the movie, we'll just have this play one more time through and just push it so that you don't have to try to figure out where it is on the website. So I'll do an audible. I don't know how the rest of the community may feel, but getting that information to you is very, very important, whether it's this forum or another. But I did bring up the website as well. This is the Motus website. And if you want to dig in a little deeper, when you scroll down to the bottom, there's a login. This takes you to, are you a new user? Enter your HOA code. Does anybody remember what the HOA code is?
SMG 903.
903. So this is your ticket in. And look, there's another video for you to learn a little bit more about Motus. And then, if you want to continue further, when you go, you create an account, and now you've created your own personal line with Motus. We just got you through the front door, and that's really our role as an association.
The frequently asked questions is a good thing to look at too, just to get clarity.
But every insurance course I've gone to is 3 to 4 days. You don't just pick up insurance immediately and just walk out the door in an hour. So we get it. We're fitting a lot in a short amount of time. It's also why we're recording this, so you can watch it again and with anybody else as well.
Is there a deadline for signing up?
Yes.
Cliff, you want to handle that?
The 25th of this month. You can sign up after that, but there is a penalty if you do so. It's not all that expensive. It's $75 additional. But if you sign up by the 25th of this month, then there is no penalty.
And why is that? Why are they rushing us to make a decision? Just like open enrollment for medical insurance to be able to write a policy, they need to know how many people are kind of participating in the program. It doesn't mean that you can't ever join again. I don't know if there's an annual open enrollment or is it just a one-time?
There's an annual open.
Yes.
Okay, annual open enrollment. So October is going to be our enrollment period, just like my medical benefits open enrollment is in March. And if somebody moves into Smith Ranch Homes, they have a period of time. They don't have to wait until October, so there's a window for them. I think the late fee is maybe $75, and I think I'm talking to the board, or I've talked to the board that maybe for this 1 year, Smith Ranch will eat that cost, because how many $75 could that be? Well, we don't want to rush you either. But we do think with the amount of information we've given you, with a couple more weeks ahead of you, working with your team, you should be able to get an answer without feeling rushed. We actually moved that deadline out. They were looking for it to be a little earlier, but we said, no, not for our group.
One last question.
Yes, Lynn, that's all right. All questions. Well, I asked for participation, and you guys are doing great.
If there is really a catastrophic loss, and very few owners have purchased insurance, this place would never be rebuilt. So what happens then?
Well, Alex Yanoff, our expert, said, based on where we are, the soil type, the distance to the earthquake faults, that we are not on top of an earthquake fault. It's his professional opinion that we would never suffer a catastrophic loss.
Well, let me add to that on the insurance side though. If that happened, if that happened, the Motus program pays out in cash the amount of insurance that you bought. If that happens, you get paid. You just get, exactly, you get it. If they're not gonna rebuild it, you get your value and
And the 10.0 could hit tomorrow, right? At the same time too. We don't know, but we just know educated guess based on facts and construction. We feel like we're in a reasonable, safe space for the association's insurance coverage, let alone literally where we are on a fault line. Okay, any questions from the group? We have a couple more. Great. Izzy, going to come around?
Is this working?
Should be on. Put it close to your mouth, but
Okay, the question I had, and I think you already covered it, I just want to be sure. The top figure of the insurance, the interior coverage insurance, the top cover goes hand in hand with the loss and the buy down, right? Is that correct? In other words, you have to take the top, you have to take the interior coverage in order to get the loss insurance and the buy down. You're nodding your head, yeah. That's what I wanted. There's no separate.
you just need to have a base policy in force, and then the other options are yours. Just what you said, yeah.
You have to have, you have to have one, you don't have to have two. You have to have
No,
one.
I know that. I was concerned.
Exactly, that's right.
And what is the,
oh, make sure the mic's close. I know it's awkward, but that's how we hear you.
If you do the pay down, then what coverage do you have from loss of use, actually? Is it like you
Loss
can
of
just?
use loss of use is a separate, that's the second one.
Right.
And then the pay down of
Unfortunately, I closed
the
out.
assessment is a separate.
What I'd like to know is if you.
Well, loss of use, if you have to go live
Right,
somewhere else,
right.
you have $100,000 limit that will pay
Okay.
for that
that's
loss
what I
of use.
wanted to know.
Yes, yeah.
Dean has another question. And I'm sorry, gang, I logged out and don't have that screen in front of me. Izzy, if you can give me your password in front of everybody.
But that loss of use line also includes contents coverage.
Yeah, you can have the contents can be in there too. They'll
Is-
cover either one. Or
Either
both,
one?
all together, it's a
Or
pot,
both.
100,000 for all of it.
So if I take out the 110,000 at the top of the list here, that doesn't cover contents?
That part doesn't cover contents.
So, contents, what you need to think about, contents are those items of property that you would take with you if you move, i.e. clothes and maybe furniture. That's what the contents refers to. The other property, the refrigerator, the carpet, the drapery, you normally the light fixtures, you're not gonna take those with you if you move. Those are covered under this portion, under this limit here. This limit is for the personal contents, again, personal property, those items that you'll take with you if you move. And generally, in an earthquake, and that we would expect here, your personal property is really probably not gonna suffer damage. I mean, your clothes are probably not gonna be destroyed. They may have to be cleaned, but they won't be destroyed.
And when you look at the premium costs, far be it for me to say what's affordable or what's not. I know I had earthquake insurance originally on my home, and then we made some changes. But the amounts that you're actually paying for on the premium, I think there is a lot of value on the backside for relatively small investment versus what I was paying with the California Earthquake Authority, which was not cheap at all.
I do think if you watch that video, you'll start to see it better. In fact, now that we've had this conversation, you go watch the video, you're gonna, oh, I see what they're saying. Yeah.
So it's my understanding that contents is not involved with art or carpets or anything of that nature, and if that's a separate policy usually?
Actually, thank you for bringing that up. All works of art, expensive tapestry that you may have on the walls, but works of art and glassware is not covered under any of these policies. And what a person who wants coverage for that kind of property, you need to consider what's called a personal articles floater. And it is on our general resident information sheet on insurance.
You know, we should probably also, when we drill down, because they just say contents coverage, but I think for Motus, when he gives his explanation, when he's drilling down what contents is, because they have their own definition. I think it's a little broader than it sounds. It sounds like it's this chair and then the rest of it. It's really, it's broader than that.
Any other questions? Well, I think you were able to get a much different presentation than what our last week's group had. You get all of this plus the video, and I know we keep referring to the video, but let us find ways to push that to you in a couple of different other formats, but we hope you found some value today, and I get it. Smoke's coming out of our ears, but all of you also have different circumstances from each other, and so we can't just say, do this and don't do that.
But I'll stay if anybody has other questions you'd like to ask. And remember, we have a little a view of squirrels, so you may want to go home and watch that because it really is funny.
Thank you.